Short-term rentals, where you've got tenants coming in, 5, 6 different tenants every month, your opportunity for messing up or having issues is quite a bit higher. The best way to make money in real estate is to add value, add value, add value.
Today, I'm joined by special guest Jacob Mueller. After acquiring enough real estate to retire at 31 years old, Jacob founded Renjoy, a short-term rental management company, and he grew it from $0 to $4 million in top-line revenue in less than 3 years. Effectively operating short-term rentals is no walk in the park. Jacob pulls back the curtain and shares some of the keys to success that serve him and his clients well. We also talk about the pros and cons of diving into short-term rentals, and he dishes out some great tactical advice on how to align your strategy with your long-term goals. All right, let's get into it. Jacob Mueller, calling in from Colorado Springs here. Jacob, I have gotten the pleasure of kind of getting to know your story a bit, but why don't you go ahead and introduce yourself to my audience in your own words?
Pleasure to be here. Thanks, Aaron. So I have grown up in Colorado Springs in particular. I've been here most of my professional life, and I've been in real estate in a couple of different ways. I was a commercial real estate broker, lease properties for tenants like Tom and Jerry's or just other like large scale vendors. And I became a broker on the residential side for investors, mostly representing buy side. And I would help them kind of identify property, find ways to add value, show them different ways to acquire debt, and basically structure deals in really unique ways so they could unlock a lot of value. And I did that for several years, was a very successful broker, but I saw that the interest rate environment was changing. I realized, hey, I should probably make a shift here into property management. But when I thought about property management for my own rentals and other things, I realized long-term property management's not for me. And so I had an Airbnb at the time. Mostly long-term rentals were in my portfolio, but I had one Airbnb. And I decided to explore that a little bit further on the short-term rental side. And so over the last 5 years, I've acquired about 18 doors myself personally, and I've helped represent people on about 200 transactions. And now we manage about 180 short-term rentals today.
Amazing. Yeah. So a lot of different threads I want to pull on there. Let's, I guess, chronologically go. You entered as a broker in the commercial space. You decided that wasn't for you. How did you identify right out of the gate that you wanted to work with investors instead of your typical home buyer?
And actually this back. So my background growing up, my dad, he's a financial advisor. He's in private practice. So he's not with a big firm. He's a CFP, CFA, CPA. He runs his office, a family office for a couple of high net worth individuals. And so I grew up around this idea of capital preservation, capital growth, just this whole mentality of respect around capital. So that's like my background growing up as a kid. He even had like a small 12 unit apartment building, class C. I mean, it was terrible. And I was the one running around doing the turns on the roof in the middle of summer, like patching this asphalt ceiling. It was terrible. And I told myself I was never going to own real estate. And then as I grew up, I began to see, as many of us do, our father's wisdom. And I realized, you know what? Real estate's actually really powerful for building wealth for myself and for my family and for future generations, and completely changed course over time. And so when I went into commercial brokerage, it was the mindset of, I want to learn how to invest in commercial real estate, and I'm going to do that best by being an agent. And I realized that was not actually the real estate industry I wanted to go down.
Got it. What would you say it was about the commercial industry that turned you off to that and towards residential though?
I found the commercial real estate, I mean, in that world, a lot of them view litigation as a primary means of generating wealth. And so they look for ways to screw tenants or partners. Like they're intentionally looking for ways to generate a lawsuit as one of the main vehicles for creating income and wealth for themselves. I just didn't want to be in that world. And that may not be true of everybody's experience, just to be clear. That was just my experience of it.
Yeah. One of the things, and I'm sure we'll get into this, but with residential real estate, if it's under 4 units, like it goes along with the overall market forces. It's not valued based on the revenue it generates necessarily. The barriers to entry are much lower. When you get into these larger commercial deals, you're playing a totally different game. And if you don't have as much experience or if you're not as networked, I'm sure it can be, I don't know, off-putting at times. Yeah.
You have to be careful. When you start swimming in commercial real estate waters, you need to be very careful.
Yeah, definitely. But the residential side, I mean, that's where I spend my time. It sounds like you found a niche there. Not only you learned the long-term rental route, you built some yourself, but now you focus primarily on short-term rentals. So before we get into your company, what's the composure and how did you build your 18 unit personal portfolio?
Yeah, great question. I mean, it sounds amazing. And you hear all these stories from everybody on their podcast, like, how on earth did they do that? And the reality is, I got lucky in a lot of ways. I was starting to really dive into real estate at the beginning of ZIRP, zero interest rate policy. And so I was just at the beginning of that super hot market. And so there were just transactions all over the place. There's a lot of opportunity to make money if you were smart and paying attention. And so honestly, I got really lucky, Aaron. But what I did is, as I switched from that commercial real estate position to this residential investment brokerage, I learned a lot from the company I was at. It was a firm out of Denver called Atlas Real Estate. They're really big now. I think they manage like 12 or 13,000 long-term rentals. And at the time they only had like 3,000. But at that firm, it was really cool because all of the individuals who worked at that firm were investors themselves. And so my boss, my employee broker, Michael Hills, was amazing. I mean, he probably at the time I came on board owned about 50 rentals himself. And so he taught me a lot of things. Some of the things that he taught me was how to find a deal, how to value a deal, how to capture the value in a deal. So I started doing some flips on the side. I started doing some wholetailing, where I'd basically buy a property from somebody who needed to be out in a week, and then I would just relist it without doing anything. And that's just the value of having cash, right? And so that was how I really got started. And as I was flipping, I was realizing, hey, the government's taking like 40% of my gains. This is not very fun. And so he explained, okay, now next step, now that you know how to flip and add value and price out a cosmetic repair, now you need to learn how to hold on to these assets over a long period of time. So then I started shifting from just flipping to I'd flip one, I'd hold one, I'd flip two, and I'd hold one, and then I'd flip three, and I'd hold two, or that was how I got started. And those became my long-term rentals. And so right now, I think I have 4 or 5 single family homes that are long-term rentals now in my personal portfolio. But through that process, I began to look at the market in a different way. And I began to look and see, hey, where is somebody inexperienced or doing something that doesn't make sense in the marketplace? And where can I capture that value? And you just gain a sense. When you look at deals a lot, you gain a sense of what is a deal and what's not a deal. And you pull a little bit. I like what you said earlier about pulling on the thread. I learned to do that. So perfect example. There was a commercial building in this cute little old downtown area of Colorado Springs called Old Colorado City. It actually used to be the capital of the Colorado Territory before it became a state. So it's really super cool history. This commercial building was mixed use. It had apartments, it had a commercial space. It wasn't huge. The whole building's probably 5,000 square feet. And I saw that it was listed by a residential agent. And when they listed it, I thought that price seems really low. That's weird. And then I found out, oh, this is a residential broker who listed this. Probably has no idea what he's doing. And so that's when I went in, I'm like, I'm going to try to buy this property as quickly as possible. I literally, when I saw that property, got listed at about 9 a.m. on a Saturday. I was watching a football game with my wife and one of my friends. And we told our friend, like, hey, dude, hang out. We got to go look at this building. Like, we'll be back. We literally got up during this game, left my friend at our house to go look at this building within an hour of it being listed. And we had a cash offer before the end of the day in their hands. And that deal proved to be obviously very lucrative. So it's items like that where you learn as you're looking at the market, you understand, hey, this seems underpriced or something's funny going on here. I wonder if I could add value or capture some value in some way.
One of the things though, and this is, I guess, a different part of the conversation, is sacrifice in general, right? So a lot of the people listening to this show, they work full time. They probably have families or plan to have families, and they're trying to figure out how to build a real estate business in the margins of their time without it fully taking over. So in my mind, the first place my head gravitates toward is finding teammates or agents, deal finders, property managers that can help produce the types of deals that they're looking for. But your experience, it sounds like it was very active, right? Like you were really involved. So what would your kind of advice be to somebody who's looking to build this type of business in the margins of their time versus like treating it like a full-time?
When you have just those smaller margins of time, don't expect necessarily the same result or the same time frame rather of those results. And that's totally fine. That's totally okay. And I'm not trying to sell Aaron, I'm not trying to sell myself, but your time will best be spent talking to people like Aaron and talking to people like me. That's where you are going to unlock the most amount of value with the little amount of time you have, is finding those people who have actually done the real work and who have integrity. Those are two really hard things, honestly, to find, because there are a lot of people who say they've done the work, but they haven't actually. And then they try to sell you something that's not actually valuable for you towards achieving your goals. Or they have the experience, but they don't have integrity. And so they shyster you out of your money. And so you have to be very careful. And I think the best way, listeners, if you are really busy, It's to spend the time identifying who are these potential people and then just scheduling call after call. I mean, you can get to know somebody really quickly. Like if you pick up the phone and you called me and you said, this guy's within 2 minutes of our conversation, this guy is a total tool. I don't want to work with him. That was only 3 minutes of your time that we actually spoke with that person. And so then you can make the next call. And so I find that doing the research on who in your marketplace in particular, or where you want to invest in particular, finding the people who are good, boots on the ground, doing the real work and know what they're doing is going to be by far the most efficient use of your time.
100%. Yeah. So building a team of people that you can trust, they jive with your values, and they have access to the tools or network or deal flow or whatever it is that you need to accomplish your goals. And I think the other important thing I heard you hint at is that it's like playing your own game, right? If you want to do this in 20 or 30 minutes a day, you probably shouldn't expect to, buy 100 rentals in year 1 and year 2, but instead like build goals that fit and work backwards into the lifestyle you want to have. But I think one of the things, and this kind of parlays into what you do now, is there are different strategies if you do want to quote unquote speed it up and build cash flow, right? So I would love to hear from your perspective, both as an investor and now as someone who runs a property management company for short-term rentals. Why did you shift from a standard traditional long-term rental towards these vacation rental, short-term rental model?
It is an industry that's being disrupted. And whenever there's disruption in an industry, there's opportunity. I saw a couple of former clients of mine doing really well in the short-term rental space. And I thought, this is fascinating. Now, of course, it was during ZIRP. And so the profits were ridiculous and that shouldn't be expected over the long term, but still it was a really interesting real estate investing model I hadn't run into when I was at Atlas Real Estate. And so those two clients actually became my partners of the company today. I made the switch for a lot of reasons, but the main one again is that disruption's there. And I noticed too, there's this big trend in the short-term rental investment space where the entire industry is starting to professionalize in ways that it hasn't historically or hasn't been possible historically because of the advent of technology. It allows for a lot of different ways to approach scale that didn't exist before, mainly through acquiring guests. It became way cheaper through Airbnb and VRBO, the ability to acquire these guests from wherever, all over the world to come stay in your property became astronomically cheaper. That was the big innovation of Airbnb. That tenant acquisition or the guest acquisition costs came down massively. And so the cash flow has always been there around short-term rentals. They've always been a higher yield investment vehicle. But what's made it really hard is that it's usually very isolated to a very specific location. You can't invest in that real estate in a lot of other ways. And then there are downsides off of the cash flow side of those locations. So if you buy a place in, I'm trying to think of a luxury destination or vacation destination. Let's say you buy a place in a small beach town. There's not a lot of economic drivers driving up the value of the homes in general because people need to live there to work. People only go there to vacation. And so you have some downside risk on your appreciation because there's no like fundamental economic driver of the region to improve the overall asset prices. And so that's traditionally been the downside of vacation rentals. But because of this change in acquisition of guests through Airbnb, now you can own places in thriving economic driving city centers like a Denver or a Houston or wherever you may be. If you're in a large, fast growing city, you can actually have access to this higher yield while also not having this downside appreciation risk. So those are the two main things.
Yeah. So what do we say if you're just a passive observer, and you see if you're tapped into bigger pockets and you're maybe just getting into investing, all these articles over the last 12 to 18 months, STR is dead, it's drying up, there's less demand, people are going back to hotels. I mean, I'm teeing up some things that I've seen on headlines. Like, what is your kind of reaction to that as far as the long-term durability of the industry? Is it that only the cream of the crop is going to survive, or what is behind all those takes?
I actually am excited that people read that and believe it. So, because then it just means there's less supply to compete with. I love it. It is true that we provided more supply than demand. However, it's false that demand is shrinking. Demand is still growing pretty dramatically in the short-term rental industry space. The alternative accommodation space, I think is what it's called. And it's still growing almost double digits. And it's projected to grow double digits over the coming several years, the demand for these alternative accommodations outside of hotels. So the demand is still growing. So it's false to say that, it's empirically false to say that the industry is shrinking or something like that. But what has happened is supply outpaced that demand growth for a long period of time. And so people who got into the game early are definitely not earning the same profits that they had been. And so there's a perception that, hey, I'm not earning nearly as much as I was. Maybe I allowed my costs to climb a little bit. I wasn't super disciplined on ensuring my property's P&L stayed tight. My costs were controlled, all those things, because I was making so much money. And now you're feeling the revenue coming down, but your costs aren't coming down because it's hard to reduce costs. And so now you're starting to feel a squeeze. And I think a lot of people are in that position. And that's actually another example of why I love being in this particular niche of real estate.
Yeah, no, that's fascinating. And I just, full disclaimer, I don't own a short-term rental. I know several people that do, and I've had a lot of conversations about it. But my understanding is one of the harder things when you're buying over the last couple of years is that when people provide you their trailing, if you buy one that's already in operations and they provide, hey, here's what I made in the trailing 12 or 24 months, a lot of that data still has some skew from it, 2021, 2022.
Yes.
And the sellers are always trying to position it like, hey, look, this is exactly how it's going to be. And like you said, there's some headwinds, whether it's the compression of the goods supply or people, some of the trends normalizing after COVID. And I know it's a few years after at this point, but it's just interesting. Like if I was an everyday investor, use me as an example, definitely interested in short-term rental, but have not bought one. Part of it's because I don't trust my ability to understand what is a good deal and what is not. So like if you were working with someone who had long-term rentals, but was interested in getting into short-term rentals, like how would you go about educating them to spot a good deal?
Yeah, absolutely. I mean, the first place to start is obviously with your end in mind. So let's say we're having a brand new conversation here, and this is how it should go, by the way, for your listeners, not with me in particular, but if you were interviewing somebody, this is how they should really be responding, or some flavor of this. Aaron, I'm glad you're interested in short-term rentals. It sounds like you've been a pretty sophisticated investor. You have a handful of rentals already. There are some really important differences between short-term rentals and long-term rentals. But before we really start diving in and start looking at properties or deals or anything, I need a better understanding of your why and your goals. Like, what are you trying to achieve and in what time frame? And why are we even having this conversation about short-term rentals if these long-term rentals have been successful for you? So they should ask, hey, what's your goal? Where are you trying to go? Because I may not be able to help you go to where you're trying to go. And they need to know that right up front so you don't waste anybody's time.
Most people think I'm full of crap when I say that I can operate and grow my portfolio in an average of 20 minutes per day. So instead of asking you to take my word for it, I sat down with my business partner, Nathan, and we ran through our entire 20-minute investor strategy in a free workshop. We go through all the different workflows, software, and tools we use to stay in control of our portfolios so we can focus on what matters most to us. You can watch the entire workshop and download our workflows for free at 20minuteinvestor.com. Again, that's 20minuteinvestor.com. And back to the show. So here, let's game it out a little bit. So I have my 8 long-term rentals. I've generated about $5,000 a month in net cash flow. It's really great. It's had a huge impact on my family. We've operated them well and we're really comfortable, but we can't save up capital the way we used to be able to because we have our 3 young kids. Our household expenses are much greater. So we can only really make 1 or 2 plays every 12 to 24 months. And so we want to make each play that we make, each additional investment that we buy, we want it to have a bit of a higher impact.
Totally.
And ultimately, our primary goal is to add another, let's say, at least $1,000 a month per net cash flow per property. And we can't do that with long-term standard rentals. So we're looking to diversify into short-term rentals, understanding that there's a lot of things that it takes to generate $1,000 a month. How do I get there?
Yeah, absolutely. Well, there's no magic ball. It's not like in the world of investing, risk and return always go together. And so we can probably find deals that earn you that kind of additional net cash flow in your pocket. But obviously there's additional risk with these things. And that risk can come in a lot of ways. It can come in poor operations once the thing is running, because operations are far more complex to short-term rentals than long-term. Like it's pretty hard to mess up a duplex, like with a long-term tenant. I mean, it can happen. And some people definitely have horror stories, but it's actually pretty hard. With short-term rentals where you've got tenants coming in, 5, 6 different tenants every month, your opportunity for messing up is quite a bit, or having issues is quite a bit higher. So operational risk is higher. The second thing that's higher is you have legislative risk or legal risk of no longer being able to operate as a short-term rental. You pencil the deal as this short-term rental, and then a year later, the citizens of that town or whatever say, hey, no more. We're going to change the laws or the rules around short-term rentals. All of a sudden, your entire model is blown up. So that's another risk. Let's see. A third risk is it does typically require more capital than a standard long-term rental deal, because you have to furnish and set up a property in order to compete for those guests. And you have to do it in a way that's smart and intelligent. And it's not by doing it at the lowest cost possible. So if you want to get into short-term rentals, keep in mind, there are additional risks that come along with it. You do get the benefit of additional cash flow, but you also have more risk. And from my perspective, Aaron, with what you shared with me, I actually think that's a pretty good move for your portfolio because you have a lot of hedging. You already have these long-term rentals. You already have a pretty good stable cash flow. It's probably okay to try to go for a higher yield, higher risk investment at this point because you already have a really strong base. Now, to find those deals, I always tell people the best way to make money in real estate is to add value. Always look for opportunities to add value. You don't have to have a ton of time to be able to do that because there are really good partners you can work with who will help you add the value to the property. I often hear adding value is complicated and takes a lot of time. It's like, it's true unless you find somebody you really trust who can help you do that process as well. Perfect example of adding value is, let's say you're talking to somebody and we say, hey, 3 bedrooms in our market in the short-term rental space earn pretty good revenue. Maybe they earn $600 a month in net cash flow on average. But if you can move up to that 4th bedroom category, you can see a $1,000 or $1,200 cash flow increase. But 4-bedroom houses are more expensive. So let's go find a 3-bedroom house that has a lot of more square footage than it really should and find a way to add a 4th bedroom, build that 4th bedroom, modify it to become a short-term rental. And we're going to pay a lower price because it's a smaller house. We're going to add value to get to this higher tier of revenue. And we're going to generate equity basically for you as the homeowner or the investor. So that's how we would help you make additional income there, Aaron.
Got it. So spotting some additional opportunities to add value, similar to if you were doing something like a BRRRR strategy on a long-term rental or even a flip, right?
Sure.
But you're saying in addition to adding the bedroom, you would optimize it in such a way that it would work for a short-term rental strategy. And instead of taking the room rates, nightly rates that you would get for a 3-bedroom, all of a sudden you've created 4-bedroom. So you have extra equity in the home and you're driving a higher revenue than you would have if you bought it as a 4-bedroom
at a lower cost. Yep. You're driving that additional revenue premium at a lower cost because it is really hard right now to find deals that make sense with interest rates the way they are. It's very difficult.
Yeah, makes sense. So then from the business model perspective, one kind of blanket statement that I've heard and somewhat believe based on the other short-term investors that I know that self-manage is that it's about 4 times the revenue of a long-term rental and 10 times the work. So I know you run a short-term management company. And first of all, do you think that statement's accurate for someone who's an inexperienced operator trying to start their own short-term rental and bring it up to speed? And second, what are the kind of pros and cons of self-managing versus bringing on like a full stop manager, knowing that you're going to have to sacrifice a pretty big percentage of your revenue to do so?
Yeah, that's a great question. The 4 times the revenue, 10 times the work. I think that's probably about right. My gut says, yeah, that's probably about right. I haven't heard that before, but I think that's probably right. And it will vary, right? Like as you scale or add more units, your like work per unit goes down, right? You start achieving some economies of scale, but then you hit a wall. So like what happened for me personally is I got to about 6 or 7 Airbnbs plus my long-term rental. And I'm like, this is like a lot of work. I can't go on vacation. I can't I have people helping me, but at the end of the day, like there's so much happening that I have to basically be on call all the time. I can't not be. And so that was the point where I realized I need to either hand it over to a manager or I need to divest or turn them into long-terms or whatever. Cause it's not working with my lifestyle and my family. Cause I actually have a little kiddo too. What I would tell people is like, it depends on how much room you have. If you only have 20 minutes a day, you are probably not going to be able to self-manage an Airbnb, even if it's in your basement, right? Like even if it's like in your backyard, even if it's really close and easy in a lot of ways. And let's say even if your wife does the cleaning or you do the cleaning or your partner does the cleaning, or your kids do the cleaning. I mean, there's like a lot of ways you can try to do this, but the reality is it's going to be a lot more work than 20 minutes a day, no matter what. And so if that's all you have, you probably can't go the self-management route. I just would not recommend it. Managers are expensive. Like we're expensive, 100%. In general, what I tell people is like, it is passive, our managers, but you earn about 140% of what you would earn as a long-term rental in terms of your net income distribution. So even though your operating expenses, including a management fee, are way higher with a short-term rental, you still at the end of the month are going to get an increased net distribution than you would for a long-term. And again, the main fundamental reason for that, Aaron, is because you have more risk. even if you do have a manager there, you do have more risk as a homeowner. Like a lawsuit, a guest slips and falls and sues you and files a home insurance claim. That's likely, or is far more likely than on a long-term rental. So there's all these different little aspects of increased risk that result in higher yield. But even with a manager, and let's say it is only 20 minutes a day, you can do it, but it just comes with that higher risk, and you have to be aware of that.
Understood. And yeah, so my understanding of the business model for property management on short-term rentals is it's usually somewhere between 25 and 40% of top line revenue. Is that about standard for the industry?
Are you talking about operating expenses or a PM commission?
No, sorry, the PM fee.
Oh yeah, no, if they're above 30%, you should probably run. Yeah, that's really high. That's really high.
Yeah, because it's top line revenue, right? So essentially, like, I'm trying to understand the incentive structure here, because if they're generating revenue, but then they're bleeding on the operating expenses, there's no penalty necessarily for how they operate. So are there different ways when you are working with a client and you're reporting back to them, hey, here's how you did last month or last quarter? Do you look at things like expense ratios? Like, we were able to hold operating costs under X, and we were able to drive room rates up by this percentage year over year. Like, do you have those type of conversations with your clients?
Yeah, generally what we look at is your alternative options with the asset. So we say, hey, you were distributed X number of dollars this month. If you had gone an alternative method with this real estate, here's what you probably would have earned. Here's what the market rate is for rent. Take off your 30% OPEX there because you still have a manager. Yeah, we may have operated a 45% OPEX or something like that. But here you compare them next to each other month over month. But the other big thing with short-term rentals is that the income is variable. So you don't, and seasonal. What I mean by that is seasonal. And so you can end up in a couple of months out of the year where you actually earn less than you would have if it was a long-term rental or some other rental. But when you annualize it, you earn quite a bit more than if it was a long-term rental. And that variability in cash flow is also a reason why you need to have more cash flow on an annualized basis, because there's risk associated with that lack of consistent cash flow. But yeah, we absolutely talk to our owners about operating expenses. The big thing that your listeners should always ask a property manager, if they're thinking about a short-term rental property manager, don't ask them what their fee is. Don't ask them what their operating structure is. Don't really ask them any of them. Ask them, what is your take rate? Because in the short-term rental industry, you will not find, I haven't, 2 short-term rentals who charge owners the exact same way. It is literally different from every single manager on how you get charged. And it is really hard to understand where is the money actually going. It is very difficult. Very opaque, very hard to understand. In our industry, from an internal metric, when one manager is talking to another manager, one of the big questions they ask each other is, hey, what's your take rate? That means how much of the money that you're collecting on behalf of an owner are you keeping? Are you taking? So for every dollar you bring in, regardless of its source, doesn't matter if it's tax revenue, doesn't matter if it's a cleaning fee, doesn't matter. Every dollar that lands into your trust bank account, how much of that are you moving into your operating bank account? And that is the question to ask. You will make a lot of managers very uncomfortable when you ask that question, but that is the one to ask, because the way that they charge doesn't matter. Whether they charge you all these maintenance fees, or they charge you a hot tub fee, or they collect 100% of the cleaning fees and only charge you a commission on your accommodation fee, or whatever. None of that really matters. At the end of the day is, how much money did you collect on my behalf and how much are you keeping? And that's the real price you're paying.
Got it. So what's a good benchmark? If you ask that question and you're interviewing managers, like, what should an investor look out for, or what would they perceive as a good take rate?
Yeah. So there's another nuance here that depends on, does that manager do maintenance in-house and housekeeping in-house? Like, how many of the expenses do they push off to you as a homeowner? Because some managers, like ourselves, are white glove. We say we do literally everything. So you won't have any costs outside of us unless you choose to pay your utilities on your own, and then obviously your debt service on your own and your insurance on your own. Other than that, literally every expense will flow through us. However, some managers won't be that way, right? Some managers will say, hey, look, landscaping's all on you, like Vacasa, huge in the short-term rental management space, biggest one. And they won't touch pools, they won't touch lawns, they won't do anything around those. You as a homeowner still have to organize and pay your vendors. And so I make that distinction, Aaron, because your take rate's is going to reflect that. So if it's a white glove service, you should expect a take rate of around 40%.
Got it. Yeah. See, if I was hiring a short-term management company and they refused to touch the pools or do standard maintenance, I would not be very happy.
Of course not. What's the point?
Yeah. So it's an interesting, the reason my wife and my personal real estate plan that we haven't ventured that direction is largely the unknown. And it's, can we really find a trusted partner or a management company that we believe in and can understand what they're doing? Like you said, the transparency, and understand the inflow and outflow, and understand the benchmarks to even aim for. It just is a totally different type of business than a long-term rental. I mean, and the dynamics to succeed, the hospitality element, dynamic pricing, and like you said, there's all that seasonal, like being able to ride those waves figuratively and figure out like what to charge on any given rate, how to stay in line with competitors. I mean, it is a very active business, and it's interesting to even think that it's the same asset class, real estate, because it's really a hospitality business transposed on top of a real estate asset.
That's right.
So,
yep, that's right. It's a completely different business model to long-term renting. It really is.
Yes. Yep. So I'm trying to think of other angles that might be useful to someone who's coming from long distance and considering this. Do most of your clients start with short-term rentals, or do you find a lot of people that are making that switch or graduation from another strategy into this?
Yeah, that's a great question. Honestly, it's a pretty big mix. We do have quite a few large investors who own long-term rentals, short-term rentals, some own commercial building. We do have pretty mixed portfolio of investors, but I would say they're probably 30% of our owner mix. We have a lot of homeowners who want a second home, but it's not primarily a second home. It's primarily an investment that they happen to want to use there occasionally as a second home. More of, some people call them lifestyle assets, but I'm not entirely, I guess maybe that's what it is, a lifestyle asset, because the homeowner only uses it a couple of weeks out of the year and their primary goal is revenue. In the traditional vacation rental management space, it's going to be the flip of that. We're like, hey, this is our second home. We want to rent it out occasionally to like cover some of our costs, but this is for us. And we generally don't work with very many of those homeowners because we're not built for that. We're built for investors. So I would say that's probably another 30% lifestyle assets. And then the last kind of 40% is a really just eclectic mix. It's mostly people who end up owning this piece of real estate and they don't want to get rid of it. It's not a good time to sell. They don't really want to do the long-term rental setup because they may be coming back to the city for work, or they don't want to commit basically to locking up their property with a tenant. And so a lot of these people will move away and just rent out their existing property short-term and become almost accidental landlords, as it's been called. We end up with quite a few of those as well.
Yeah, that's fascinating, because pretty much everyone I've ever coached or anyone who I've talked to that wants to make real estate a part of their long-term plan, short-term rentals crosses their mind at some point, but then when they learn about all the complexities of the business and what it would take to self-manage, they usually shift back towards, well, maybe I'll start with long-term rentals, which my personal thesis is that's a good place to start because the barriers to entry are much lower. And like you said earlier, it's pretty hard to screw it up, right?
Yeah.
Even if you're inexperienced, if you're going to make mistakes, it would be better to make them in an environment like that, where you have a ton of people to draw experience from, and there's very few things that can happen that can't be corrected. But if you botch a short-term rental and you get a bad review, or you, like you said, something bad happens, you don't have a well-maintained property, somebody slips and falls and sues you. I mean, it can take you not only out of business, but like it can really wreck things for you personally and financially. So no, it's interesting. And then the last theme I kind of want to touch on here. So you are an investor, but you've also started a business. You have now 2 partners. You guys have scaled. I can't remember how many markets you're in, but you're in multiple markets now. And I read through on your site, you guys have a clear vision of how you want to not only scale your company, but you also want to continue to keep customer service and service of your clients at the forefront of that. So my question for you as a business owner is, how do you continue to scale in such a white glove, not only white glove for your clients, but white glove for the end customers, the people that are staying in these homes? How do you continue to scale without sacrificing the quality of that?
Yeah, that's a great question. It's really hard. And we have a lot to improve on and to be better at. I mean, we're not by no means perfect. We have 2 main goals here though. Like when we started our company, me and my 2 partners sat down and we spent a lot of time just really thinking about why we're doing this and what we want it to be. And we decided that what we really see, we love investing. We love investors. We want to serve that group of people. We want to help people become investors as well. And so we set two goals for our company over the next 10 years. One was to have at least 1,000 owners because we wanted to have some impact. We didn't want to just have 100 owners in like one market. We wanted to have bigger impact than that. And then the second thing we set out to do is to distribute $200 million in profits to those owners over the course of the business. And we did that because it is the case, there's no denying this, that there is always a conflict of interest between an investor and a property owner and their manager. There's a conflict of interest in a lot of ways. And they can also be aligned in a lot of ways, but they're also going to be in conflict in a lot of ways. And so we set our guiding star or what our major objective to be profit for our homeowners, because that is why we exist. And when we look at an operational system or process and we're like, man, this is really expensive for our homeowners. Like, why are we doing this way? What can we do to reduce the cost and increase the efficiency and pass those savings back to our homeowners? We ask those questions all the time. Like even in our leadership meeting yesterday, we were talking about the way that we do maintenance billing. Right now, it's a very traditional setup where you build labor and materials, right? For every job on your property. We explored and had a long conversation about, well, do we move to just a fixed monthly maintenance plan and you have unlimited labor, right, on your property? So they just go $150 a month and you have no problem. Like anytime you have an issue, you just won't see a line item on your owner statement. You just have this fixed plan. And we went back and forth and decided at the end of the day, what's best for our homeowners is to just drive down our costs with our existing model. And in having those debates internally, we have all the time. Now, to your question about growing the company and scaling and maintaining service, it's really difficult. And we have had our ups and downs. You go through all these different seasons of the business where like we had to bring cleaning in-house. We used to use contractors, but now we have them as employees. And that transition was really painful for both us as a management business, but also for our owners on their properties, not from a revenue perspective, but from a guest experience perspective. And so going through that transition is very hard. And they're going to be endless transitions like that if you continue to scale and grow. But there are real benefits to our investors as well from something you mentioned, which is diversification, not just in asset type, but also in location. One of the big things I see for investors like myself included is I have a concentration risk. I have a lot of my real estate in one marketplace. And even though that market is strong, looks good, all on the up and up, there's still risk in the fact that a lot of my net worth is tied into one specific market. And one of the beautiful things about us being able to scale is we can go to our investors who already own assets in this market. We say, hey, investor, we actually are now in this market. We can operate down there similar to how we operate here, close enough so that you can expect the same kinds of things from us. We've already developed the relationship. So the risk of us not having integrity or not delivering on what we say is low. And we will do everything for you down there. We will help you identify the property. We will help build you the scope of work for adding value. We will help set it up as an Airbnb and we'll launch it. And so you as the investor, like, sweet, I just got to give you money and look at some deals. And I know because you're handling my property here that you can go do it in that other market and I'm getting diversification in my portfolio. Awesome. Let's do it. So there is real value by growing as a business. There are downsides to it for our owners as well, because we have to go through these stages of transition and they can be painful, but there's also value as well.
Yeah. And I know we don't really have time to get into it, but I've seen some of your philosophy on how you run your business. You guys run it very tight. You're constantly reevaluating and looking at, how, like you said, you can keep your costs down, keep the value high to your clients. And every time you add a market, I'm sure that comes with additional costs for you guys and additional complexities. And there's a period of time where maybe it's costing you money to make that decision, right, but then it opens up an additional market and an opportunity for you and your investors. So I think that's really cool. One thing I really appreciate, and I just want to call out, is that you've been very clear-eyed and about articulating some of the downsides and the risks during this conversation. And I think there's plenty of upside, right? Nobody would argue that there's not a ton of financial upside, both cash flow, appreciation, all the good stuff we like about real estate and short-term rentals. But it is really important to be clear-eyed about the risks. So I appreciate you being forthcoming about that. Well, as we wrap up here, this has been really informative. I've learned a lot. Where can people go if they want to find out about you or your company or any of the services you offer?
Yeah, absolutely. There's two main ways. If you just want to know more about our business and our setup, you can just find us on renjoy.com. Pretty easy. And if you want to get a hold of me, you can just email me, jacob@renjoy.com.
Awesome, man. And you have lots of different videos and blogs and stuff on your site that dig into some of the types of stuff we talked about today. I'll make sure everything is included in the show notes, and hopefully we'll have you back on again sometime.
Great. Thanks, Aaron. It was a pleasure to be here.
Thanks for coming.
Thank you for making it to the end of today's episode. As you may know, podcasts are very difficult to grow organically. If you're getting value from today's episode, I'd deeply appreciate if you could take 30 seconds to leave my show a 5-star rating and review. This will go a long way to helping me reach more listeners just like you. Thank you so much in advance.